Good morning, everyone. Welcome to the introduction session of insurance. With over a billion people and relatively youthful population, India is fast becoming a global economic power and an attractive insurance market over the decades. Economic growth in the last decade, combined with a population of over a billion and 80% of the population still not covered by insurance market, makes it one of the potentially largest markets in the future. The Indian insurance industry has undergone transformational changes since 2000 when the industry was liberalized. With a one player market to 24 in 13 years, the industry has witnessed phases of rapid growth along with extent of growth modelization and intensifying competition. There have also been a number of product and operational innovation necessitated by consumer need and increased competition among the players. Changes in the regulatory environment also had a path-breaking impact on the development of the industry. Now, let's move towards the insurance and understand what do we understand by the insurance and what is the concept of insurance. If we talk about the insurance, if we define it in different terms, it is a contract to pay compensation in certain eventualities in return for a premium. Or rather, we generally say insurance, it is basically a device for transfer of risk. Now, when we talk about the insurance, we generally say we go for an insurance either to transfer the risk or to protect the risk. So let's first understand what is the meaning of risk. The risk means that there is a possibility of loss or damage. The damage may or may not happen. For example, the earthquake may occur, but the building may not be affected at all. Therefore, insurance is done against the possibility that the damage may happen. If there is a certainty of happenings of an event or risk, insurance cannot be done. So let's understand the concept that whenever we talk about the insurance, if any event is certain in nature, the insurance company will not insure that particular event. In case of a smoker, let's take the case of a smoker. For example, certainty that the plane will be crashed or risk of lung cancer for a chain smoker. Therefore, insurance is relevant only if there are uncertainties. In case of a human being, death is certain, but the time of death is uncertain. The person is insured because of the uncertainty about the time of his death. Insurance can be done only for those things which has the risk of perishability. So, insurance does not protect the subject matter, but the consequences or losses due to that subject matter. Neither the insurance protects the asset, nor it can prevent its loss due to any perils. As we have discussed in the previous slide that the main principle underlying the insurance is nothing, it is the pooling of the risk. That means the large amount of people, they come together, they share their risk, they pool their risk, and based on that they generally go for the insurance. It is thus also known as the cooperative devise, as the large number of people, they come together to share their risk, and that risk should be similar in nature, it should be same in nature. Let's understand the various kind of definitions in detail, the various kind of definitions of insurance in detail. Fundamental definition: insurance is a system of protection against financial loss in which risk is shifted to a professional risk bearer, an insurance company. In exchange for a certain sum of money, the insurer agrees to pay the insured if loss occurs. As I have discussed in my previous slide, that the risk management can be done in a different way. So when we talk about insurance, what we do? We generally transfer our risk. That means an individual transfer our risk to the company, that is the insurer, and based on that there is an exchange between the premium the individual pay and the kind of cover that he is getting from an insurance company. Let's move towards the financial definition. The financial definition talks about two things. First is a group of individuals. That means insured is that particular person who undergoes the or who transfer his risk to the company. So insured is maybe an individual or it can be a group of individual wherein he is transferring his risk to the company and that particular individual is known as insured. As told you that insured or the individual transfer his risk from one party to another party. That another party, that is the company who is insuring or who is giving the claims, who is protecting the security of the individual, protecting the risk of the individual is known as the insurer. In order to combine loss experienced, as I have told you, basically when the individual go for a covering of the risk, it allows him to payment of premium and based on that premium the person transfer his risk. The risk is calculated or the statistical tools will be used to calculate the risk of the individual. Let's move towards the legal sense. What is the legal meaning of insurance? It is a contract by which one party, that is insurer, it is also known as a company, in consideration of a price paid to him. So in consideration that price will be known as premium here. That means the individual whatever amount that he is paying in the form of premium, according to that what amount of risk is covered or what amount of security is covered is given by the other party, that is insured, so that he shall not suffer the loss, damage or prejudice by the happening of certain specified events. So in the next session we will discuss about the principle of indemnification. That means the individual when going for a contract, he should not be in a position of loss, neither he should be in a position of profit. As discussed in the previous slides, let's understand the basic concept again. What do we understand by insurer and insured? The person undertakes the risk is called the insurer, assurer or underwriter. The person whose loss is to be made good is called insured or assured. As I have told you that when the individual, that is the insured, will pay the premium to the company, then based on that premium his risk is covered and the claim will be given to the individual during any or due to any uncertain event. So the premium is nothing but is the consideration for which the insurer undertakes to indemnify the assured against the risk is called the premium. So let's understand the concept of indemnification that we will be discussing in the next session, that is principle of indemnification. As told you, it is placing the individual in the same financial position as he was before claiming the particular thing. Let's understand the basic function of insurance. The first thing, primary function. First function is providing protection. The elementary purpose of insurance is to allow security against future risk, accidents and uncertainty. Insurance cannot arrest the risk from taking place but can for sure allow for the losses arising with the risk. Insurance is in reality a protective cover against economic loss by apportioning the risk with others. Next, collective risk bearing. Insurance is an instrument to share the financial loss. It is a medium through which few losses are divided among large number of people. All the insured add the premium towards a fund and out of which the person facing a specific risk is paid. Evaluating risk. Insurance fixes the likely volume of risk by assessing diverse factors that give rise to risk. Risk is the basis of ascertaining the premium rate as well. It provides uncertainty to the individual. Insurance is a device which assists in changing uncertainty to certainty. These all are the primary function of the insurance. Now let's move towards the secondary function of insurance. Secondary function, preventing losses. Insurance wants individuals and businessmen to embrace appropriate devise to prevent unfortunate aftermath of risk by observing safety instructions, installation of automatic sparkle or alarm system, etc., covering larger risk with small capital. Insurance associates the businessman from security investment. This is done by paying small amount of premium against larger risk and duty. Help in the development of larger industries. Insurance provides an opportunity to develop to those larger industries which have more risk in their setting up. Now let's move towards the, apart from primary secondary function, let's move towards the other functions of insurance. It is a saving and investment tool for people, that is, insurance is the best saving and investment option, restricting unnecessary expenses by the insured. Also, to take the benefit of income tax exemptions, people take up insurance as a good investment options. Medium of earning foreign exchange. Being an international business, any country can earn foreign exchange by way of issue of marine insurance policies and a different other ways. Risk-free trade. Insurance boosts export insurance, making foreign trade risk free with the help of different type of policies under marine insurance cover. Now let's move towards the essential features of insurance. The first feature is there must be a large number of similar risks. Insurance is subject to the law of large numbers. If an insurance fund is made up from the contribution of small number of persons, the contribution by individuals are likely to be so high as to be totally unacceptable. In other words, the risk will be high if the group is small and the chance of eliminating the possibility of serious losses cannot be ruled out completely. For example, a fire insurance or a marine insurance company cannot operate with only 100 houses or 50 ships. Second, the loss caused by the risk must be definite. The peril must produce a loss that is definite in time or place. Though the time and place of death are not certain, yet there is a certainty of death which is difficult to avoid and consequently its loss. Likewise, the loss caused by the burglary to a shopkeeper or to a godown due to fire is definite. This definiteness is necessary because the cost of insurance depends on the extent of hazard. If the incidence of the risk is small, the premium will be low and vice versa. This estimate is possible referring to the statistical data based on past experience. The occurrence of the loss must be accidental. Insurance in the commercial sense is not possible if the possibility of loss is so high as to be near certainty. There must be either uncertainty whether the event will ever happen or not, or if the event is one which must happen at some time. There must be uncertainty as to the time when it will happen. Ideally, the loss should be beyond the control of the insured. Losses due to depreciation, for example, are uninsurable because there is nothing accidental about their occurrence. Insurance may be written to cover against ultimately death because death is certain but the time of its happening is uncertain. The potential loss must be large enough to cause hardship. The perils insured must be capable of very large risk, such as the consequences of a jumbo jet crash or of earthquake may be insured. If very minor risks are insured, the cost may be higher than the value of protection given, and this may also increase the cost of insurance to those who seek protection against really serious hazard. The cost of insuring must be economically feasible. The cost of insurance must be within the reach of everyone, otherwise it will be confined to a very small section of people. The cost of an insurance policy includes the premium paid by the insured and the management expenses incurred by the insurers. To make insurance attractive, the premium has to be far less than the face value of the policy. And at the end, it must be possible to calculate the chance of loss. The likelihood of an event and probable extent of loss may be mathematically calculated, or it may be based on the statistical results of the past experience. If there are no available statistics of chance of loss, it is impossible to predict losses in spite of a large number of exposures and to determine the amount of premium that would be required to accumulate a common fund or pool to meet those losses. Next, there must be an insurable interest to protect, and it must be consistent with the public policy. Now, let's move toward the characteristics of insurance. Most of the points we have already discussed during the introduction when I was discussing the definition of insurance and when we were discussing the functions and characteristics of insurance. So the first is sharing of risk. Second, as I told you, is a cooperative devise. Third is evaluation of risk, payment on happening of specified event, amount of payment, large number of insured person. Insurance is not gambling. Insurance is not a charity. Protection against risk based on mutual good and faith, contract, and regulation under the law. So this was all in the today's session. In the next session, we will discuss about the principles of insurance. Thank you very much for the patience listening.